How is COVID-19 changing urban rents and house prices? And will the change be permanent? Hello, Stijn. Welcome.
Hi, Tim. How are you?
Now, Stijn, when there isn't a pandemic on, what are the reasons that people, well, like me, choose to live right in the center of a city?
Well, Tim, cities are wonderful places, right? I mean, people are agglomerated in cities because there's lots of amenities. You can go to the opera, you can go to see a rock concert, there's good restaurants around, and also because being around other smart people and, top firms is something that makes people more productive. It's something that creates new ideas. This is something that Ed Glazer has called the triumph of the city. People come together to be, have more fun in cities, be more productive in cities. And that's why we've seen kind of this rise of urbanization in the last, let's call it, 50 years, but really centuries, if you want.
You reminded me of what I've been missing during lockdown. But now my sister, however, prefers to live in the suburbs. So why does she prefer that?
Well, I think suburbs have their own kind of amenities, if you like, in the sense, and it comes mostly in the form of, I would say, lower density, right? You're not so close to your next door neighbor. That's obviously an advantage in a pandemic time. But even before, some people like a quieter life, maybe a smaller community where they get to know their neighbors a little bit better. Maybe it's a little easier to get involved in society. And, clearly, even before, people like that. I guess the big disadvantage of a suburban life is the long commute into the city, if that's where your job is.
When we do economic modelling about these sort of things, we're used to thinking about supply and demand, but I guess in centres of towns, then the supply changes in the supply. Well, I mean, that's really difficult to achieve. So I suppose the cost of rents in a city really does depend on the demand, yeah?
I think that's right? So it's definitely in the very short run, it's very hard to add new housing stock, because of all kinds of restrictions, zoning restrictions, first and foremost, getting permits, but also just the time it takes to build a new home, right? That's kind of a 1-year project for a suburban home and maybe a 5-year project for a new, multifamily tower in central London, right? So it takes a long time to add to the supplies. In the short run, you're right. The rents are set by, demand meeting a fixed supply. In the longer run, there is kind of somewhat more of an elastic response of supply, but it takes time.
Which brings us, of course, to your research, because you have been looking at the cost of housing and how that's changing during the pandemic. Now, to use that, you employ something called the bid rent function. What is that, and how do you get to it from data?
Yeah, so, the bid rent function is kind of a core concept in urban economics, and it basically thinks about kind of this notion of the monocentric city, where most of the employment takes place in the city center. And, as a result, a lot of people want to be close to their jobs, and rents are really, really high, kind of close to those jobs in the city center. But as you move away from the city center, as distance away from the city center increases, rents become cheaper and cheaper. And so the bid rent function basically plots on the horizontal axis distance from the city center, and on the vertical axis, the cost of living. So this could be either the rent or it could be the house price, right? So there's basically a bid rent function for rents and a bid rent function for prices. And that function is downward sloping traditionally, right? Because the farther you go, the lower rents are becoming.
And traditionally, was that downward slope pretty stable over time?
It was, right? So we look at this kind of over a certain period pre-pandemic, and we find that kind of that slope to be fairly constant over time for rents. For prices, there was a bit of a flattening happening kind of pre-pandemic already, depending on the location. But for rents, it's been very, very constant, pre-pandemic.
So let's have a look at what's been happening in the pandemic. Has, for rents, the slope remained the same, or has it got shallower? What data are you using for this as well?
Right. So what we will do is we will look at a particular metropolitan area and then look at all of the zip codes, the 5-digit zip codes, the postal codes, if you like, for all the locations in that MSA. And so some zip codes will be closer to the city center, some will be much farther, and that's kind of how we measure it. So it's very, very straightforward measurement. Now, what we find in the pandemic is that basically that premium for being close to the city center completely evaporates. It goes to basically zero. So the bid rent function from being steeply downward sloping essentially becomes flat. And it's a combination of rents are falling in the city center and rents are rising in the suburbs, right? And it's so strong that essentially that relationship between rent and distance is completely gone. And so that is a very sharp change. For prices, we also find a flattening, but it's not nearly as extreme. Okay, so it becomes weaker, that relationship between house prices and distance, but not nearly as strongly as for rents.
For several years, there has been concern, hasn't there, about the high price of rents and property prices in some urban centres. New York, where you live, London, where I live, San Francisco has been one that's particularly been in the news for that. Has the change been particularly strong in those areas?
That's a great question. We find that it has, right? So we find that this kind of change in the rent gradient has been particularly pronounced in places like San Francisco and New York City. And we kind of explored this a little bit more generally by looking at the largest 75 metropolitan areas in the United States and ask, what is that kind of cross-sectional relationship between what happened to that rent gradient and some features of these metropolitan areas. And what we find is that the higher house prices were, the less affordable those cities were to begin with before the pandemic, the stronger this change has been. And to dig a little deeper, what we also look at is things like how hard is it to add to the housing supply. So housing supply elasticity, we find in places where housing supply was less elastic, like San Francisco and New York, this change is stronger. And maybe most interestingly, we find that places where there's a lot of people who can work from home, according to this measure developed by Dingell and Nyman, those are the places where we see the strongest change in this rent gradient. And San Francisco, with a lot of tech workers, New York City actually also has a lot of tech workers. Those places, score very high on this working from home measure, and those are the places where we see the strongest change, right? And so that's kind of an interesting observation because it leads us to think about, well, some of this working from home could potentially be permanent. Some of that may kind of never fully revert back to our pre-pandemic, levels.
You said that the impact on property prices, was less than on the impact for rents. Why is that?
Well, I think that's an interesting question. So I think it's a combination. If you look at price levels, obviously there's other things affecting price levels. First and foremost, interest rates, right? So interest rates are at a record low. So house prices, have been rising quickly. But even that interest rate effect, of course, is kind of present both for the suburban home and for the urban home. So if you look at the difference between those price changes, that interest rate effect should difference out, so to speak, right? So the way we think about it is, what is the price? The price is really a claim to all the future rents of that house, right? So it not only reflects the current rent, but also all the future rents. And so we think this is an opportunity for our research, which is from looking at what has been happening to house prices in urban versus suburban homes and rents in urban and suburban homes, and comparing the two, we can infer something about future rents in urban versus suburban locations, right? And so this is kind of one of the main exercises we do in the paper. And so basically we're thinking, the way I like to think of it is we're looking at housing markets to see what they tell us about future rents and what they're maybe telling us about the future ability of working from home, right? If you think that that's a big driver of future rents in urban versus suburban locations. And what we find is that, the fact that house prices have not responded as strongly as rents tells us that the housing markets are expecting an urban revival, okay? What I mean by that is they're expecting urban rents to kind of catch back up to suburban rents in the next several years. And we do kind of a calculation, using a present value framework in the spirit of Campbell and Schiller to kind of back out just how much stronger will future urban rent growth be relative to suburban rent growth? How fast will this catch up be in the years to come?
Yes, because when you're calculating that really gets into why people are choosing to live where they do now. How much do we know about why at the moment there is this drive to move to the suburbs?
Right, that's the $1 million question. Absolutely, and I think we know that people. I mean, I think there was an initial response where people were just fleeing from the city like as fast as they could. A year ago, people were just escaping, for fear of COVID, obviously, and then later on, because of all the amenities that were shut down in the cities, just being in the city was not nearly as much fun as it was pre-pandemic. It was also more dangerous. And so more people left. Here we are a year after the pandemic. Some of this kind of reversal that, our paper is predicting, I feel like has begun already. We are seeing in the very latest data for January and February 2021 that some of the rents are now increasing again in the urban centers in San Francisco, in New York City. So I think people are coming back. Companies have announced to return to the office. Google, for example, in New York City will ask its people to come back in June. Other large firms are roughly on the same timeline. And so I think we will see some of that reversal beginning very soon. I do think, however, that there will be part of this shock which will be permanent. And in particular, companies have already announced that they will be much more flexible in terms of how many days they will let their employees work from home. One number you often hear is 3 days in the office, 2 days working at home. Come into the office to meet your team workers, to be productive together, but then go back home and do the thinking work that doesn't require that's something you can do on your own. And I think this kind of 3-2-2 model is something that we will evolve towards. And if that becomes a new reality, then all of a sudden we need 20% less office space in the urban core. So this is going to have major implications for office real estate, for example. It's going to have major implications for where people live, because even a 1 hour 30 commute may be bearable a couple of times a week, but not 5 days a week. Right, so it will change where we can live.
So I suppose the moral of this one is, if you're going to rent in San Francisco, it might be good to do it exactly now before the whole thing balances out again.
Exactly, and we have seen people come back. The incentives have been very strong. I know in New York City there are places where you can get, if you sign a 2-year rental contract, you get 3 months free. Right, so that's a big freebie. And you're right. I think this is a very good time to sign a new rental contract, and it might not be quite as attractive anymore 6 months from now when people are all returning to the office.
That's very interesting, Stijn. Thank you very much.
Thank you, Tim.
Stijn's paper is called Flattening the Curve, Pandemic-Induced Revaluation of Urban Real Estate, and the authors are Arpit Gupta, Vrinder Mittal, Jonas Peters and Stijn Van Nieuwerburgh. It's in COVID Economics 69. You can also find an article about this at Vox EU, and the name of the article is Flattening the Curve, Pandemic-Induced Revaluation of Urban Real Estate. Well, thanks for watching. As ever, you will find plenty of new research on the impact of COVID-19 in COVID economics. It's free, it's open access at CEPR.org.